So guys, we are going to start the beginning, I believe, 4 objectives of chapter 3, the accounting cycle. And it's at the end of the period. And there's really a lot to cover in this chapter. So that's why I've broken it into 2 weeks. If, as we're going through something, if you have questions, please ask, because I'd rather you understand this material as we're going through it. If I need to go slower, I'd like you to tell me, hey, Nancy, slow down, say it different. That does not offend me whatsoever, because remember, if you succeed, then I succeed, okay? So just remember that my job is to try to make it as understandable for you as possible. That's what I'm here for. So in this chapter, one of the first things we're going to discuss, and honestly, one of the most important concepts in accounting is the term or the concept of what we call accrual basis of accounting. And so we're going to talk about what's accrual basis of accounting. Well, basically, it's when do we record expenses? When do we record revenues? When do these suckers get recorded? Well, there's a principle called the revenue recognition principle. Revenues are recorded in the period in which the goods or services are provided to the customers. That is the revenue recognition principle. What the heck does this mean? Okay, guys. Revenues get recorded into our financial statements when we completed the service to the customer or when we provided the product to the customer, not when we got paid. This is key to accrual basis of accounting. Also, expense recognition states that expenses are reported in the financial statements in the same period as the revenues they help generate. Now, this expense recognition we call the matching principle. We're going to talk a lot about this today. Remember, revenue recognition is the revenues are recorded in the period in which we provide the goods or services to the customers, not when we get the cash. Sometimes they may coincide together, but oftentimes they don't. So we record the revenues when we've provided the services. We know when we get the cash before we provide the services, we put that as a liability in deferred revenue. Because we receive the cash, we still owe them something, which is a future sacrifice. So here's the example here of a cruise ship. I don't know how many of you guys have been on a cruise. I used to love them. I don't know if I'm going to be going on them anymore because you're around 3,000 other people in a very confined space. But boy, are they fun. So here's an example. This cruise ship occurred in April. Okay? That's when all the passengers got on the cruise and they did their 2-week venture. However, in March, the company purchased all kinds of supplies for this April cruise ship. In April, they purchased all kinds of fuel, or the cash outflow, they purchased and they paid for it in April. And then in May, they paid the salaries for the employees that worked the cruise ship in April. So throughout March, April, and May, there were costs, or cash was going out for various sources for the cruise ship that occurred in April. So the expense recognition says the supplies that were purchased in March are going to be expensed in April when they got used up. Because in April, the revenue was recorded for the cruise ship, and the supplies need to match with the revenues they helped to earn. In April, when they paid money for fuel, it just so happens that coincides with April when the revenues came in. But in May, if the salaries didn't get paid until May, when were they incurred? When were those salaries actually provided? In April. So all those costs are going to match with the revenues they helped create. So it's really important to note this matching principle is basically saying the expenses that help to generate the revenues, they match up. So most expenses are recorded in the same period as the revenues they help generate. There are other expenses that may be indirectly related to producing revenues that get recorded in the period they occur. So, and we'll talk about that. Sometimes there are advertising costs that will just be recorded when they actually happen. So here is our first check your understanding. Which statement best describes when expenses should be recorded? A, expenses are recorded when paid. Right? Expenses are recorded the day a company promises to pay. Expenses are recorded when the cost is used to help produce revenues, or D, none of the above. Why don't you put your answer in the chat box? Okay. Oh, you guys are so good. We're off to a really good start. Awesome, guys. Okay. Now, as I said at the beginning, the key, one of the most important principles or concepts in accounting is the accrual basis of accounting, saying we record revenues in the period we earn them, when we provided them, and we record expenses to match those revenues they help to create. So we're talking about this accrual basis, but what's the deal? What's going on with this accrual basis versus cash basis? Well, I want you to understand why we don't use cash basis and what the difference is, so it helps you understand the significance of the accrual basis of accounting. So here we see accrual basis compared with the cash basis of accounting. Revenue recognition is when do we report revenues? Under the accrual basis of accounting, which is how we are going to perform accounting, which is GAAP, generally accepted accounting principles, We are going to record revenues when the goods and services are actually provided to the customer. If we were to use what's called the cash basis of accounting, then we would record those revenues when we receive the cash. So it might not be that the services had been provided. Do you see where the problem is? That is why in accounting we consistently use the accrual basis of accounting. Under the expense recognition, for accrual basis of accounting, we record those expenses in the period they're used to help produce the revenues. Under the cash basis of accounting, we would record those expenses when we pay cash, when we paid for those expenses. Big difference. GAAP, generally accepted accounting principles, which are the guidelines we stand by, require accrual basis of accounting, not the cash basis of accounting. So accrual basis revenue versus the cash basis revenue. On December 12th, going back to our famous golf class, golf school, we provided golf training to customers for cash for $4,300. Well, under the accrual basis of accounting, we record it when we provide the services. Under this, did we provide the services on December 12th? We would report it on December 12th. Under the cash basis of accounting, we would record those services when we receive the cash. I'm sorry, guys. Did we receive the cash on December 12th? Yes. Therefore, we would show the revenue being recorded on December 12th. In this example, the accrual basis and the cash basis happen to align, and we would record both on December 12th. But it doesn't always work that way. On December 17th, we provide golf training to customers on account. Now, we know what this means, on account. It means we provided services, but they didn't pay us yet, did they? We did the service. We record the revenue because we provided that service to the customer. So under the accrual basis of accounting, we are going to record that revenue on December 17th. Even though we didn't get the cash, we don't care. Remember, this journal entry would be a debit to accounts receivable, a credit to revenue, service revenue. Under the cash basis of accounting, we only record revenue when we receive the cash. So we would not record any revenue until the customer pays us. I hope you're seeing why the accrual basis of accounting is preferred, because we're truly showing the activities of a company when they incurred, when it happened, not when cash was involved, when cash exchanged. Now look at December 23rd. We received cash in advance for 12 golf training sessions to be given in the future for $600. Did we provide the services? No. Under the accrual basis, that's a liability. We would debit cash, credit deferred revenue, which is a liability account because we owe them something. We have a future sacrifice. But under the cash basis of accounting, we would actually record that as revenue, even though we didn't do anything yet. We have not provided the services. How about on December 1st, we paid 1 year of rent in advance, $6,000. It's at $500 per month. We know under the accrual basis of accounting, the expense, the cost happens when just time passes. The rent has expired. You know, we pay $500 for January, $500 for February. And the passage of time shows the rent has been utilized. So we know under the accrual basis of accounting, we would treat this as a prepaid rent, and we wouldn't have an expense until the end of the first month. We would have 500. The end of the second month, we would then record 500. The end of the third month, we would record 500. There's no cost that is going to be expensed December 1st under the accrual basis of accounting. But under the cash basis of accounting, the entire $6,000 would be recorded as an expense immediately on December 1st. You see the difference? On December 6th, we purchased supplies on account. What does that mean, supplies on account? That means we purchase supplies, but we're going to pay for them later. So think about that. December 6th, we would debit supplies as an asset. We would credit accounts payable. And we wouldn't show those supplies as an expense until they get used up. But under the cash basis of accounting, we wouldn't record that as an expense either until we pay the $2,300 for those supplies. Because cash has not exchanged hands. On December 28th, we pay salaries to employees for $2,800. Since the salaries were incurred in December, we would show that cost then under the accrual basis of accounting. And under cash basis of accounting, we would show that cost because we paid for the salaries on December 28th. The key between accrual versus the cash basis of accounting is all about timing. Under accrual basis of accounting, we record our revenues when we provide our goods and services to customers, and we record our expenses with the revenues they help to generate. Under cash basis of accounting, we record revenues when we receive cash, and we record expenses when we pay cash. Most companies do not use the cash basis of accounting because it's not allowed under generally accepted accounting principles. So which of the following would be recorded as an expense under the accrual basis of accounting? A, the company purchased office supplies with cash and does not use the supplies. B, the company uses utilities in the current period but does not pay cash. C, the company provides services to customers for cash. D, the company purchases equipment by borrowing from the bank. Take a minute and record your answer in the chat. Okay. So let's talk about this. Which of these would be recorded as an expense? Now, guys, we know it's not C because the company's providing services to customers. That's revenue. That's not an expense. So C's wiped out immediately. It's not D because the company purchases equipment. What is equipment? An asset. It's not an expense. We're not going to deal with that. So C and D are wrong. Would it be A? Well, it's not A because the company purchases the office supplies with cash, but it does not use the supplies. Under the accrual basis of accounting, that is an asset, those office supplies, until they're used up. Then we treat it as an expense. So guys, the best answer here, or the correct answer, is B. The company uses utilities in the current month or period, but does not pay cash. We don't care when we pay the bill. When was the expense incurred? How about this one? Under which of the following would be recorded as an expense under the cash basis of accounting? This isn't the accrual basis. Cash basis. Okay, guys, we know it's not C and D again. C's revenue, D's an asset. Would it be A or B? Write it down. A or B? A. Perfect, guys. It would be A. It's A because the company paid cash for those supplies. That under cash basis, it's when you pay for it. It's when you treat it as an expense. So guys, we are going to start with exercise 3.1, and we're going to try to just really gain some understanding on this concept because it really is an important concept, which is going to then lead us onto some other concepts in this chapter. Number one, for each of these situations, determine the date for which the company recognizes the revenue under the accrual basis of accounting. Now, if I could have a couple of you take, like, I don't want to pinpoint anybody, but if I can pinpoint, I would love if I could get maybe Andre to do one. Chad, if you could be so kind to do number 2. June, could you do 3? And how about Richard Mueller? You were the first one to come in to this class this morning. I think you're the first one. I think you're the most excited to come to class because you're always the first one here. Would you mind doing 4? Now, guys, I'm going to also tell you this. You will never in this class feel pressured. So if you are just not in a place today to want to take it, you just say, Nancy, I want to pass. And I'm cool with that. We all have good days and bad days, so don't worry about that. But those of you who I said number 1, 2, 3, and 4, if you can, jump in, unmute your phone, your computer, jump in and do that, okay? And read it and then answer it.
Mrs. Shumay,
Yes.
can I pass today?
I told you you can pass. Of course you can, sweetheart. Okay, so how about Noah? Can you take number 1? And if Noah passes, how about Stephen X? And guys, also, I mean, that's so kind of you to call me Mrs. Shoemake, but you just make me feel older, as old as I am. I am so happy with you calling me Nancy. But if that's against your, like I was raised in the South, so I still call my parents' friends Mr. and Mrs. But in Minnesota, things are done a little different. So no, you are welcome to call me Nancy. I'm cool with that. Okay, Number one, whoever I just said. Nathan. Or Stephen X.
Okay, so number one, American Airlines collect cash on June 12th from the sale of a ticket to a customer. The flight occurs on August 16th. I guess I would say the accrual happened on August 16th because that's when the flight happened.
So you're saying that's when the revenue would be recorded?
Yes.
How many agree with Stephen X? Guess what? Stephen X is absolutely correct. So let's think this through. American Airlines, so Stephen, you got it perfect. What I'm doing is just delving a little deeper. The journal entry on June 12th, when American Airlines collects the cash from the sale of a ticket, American would debit cash, credit deferred revenue. Then on August 16th, they would debit the deferred revenue and credit sales revenue or airline revenue. Because even though they got the cash on June 12th, the service was not provided until August 16th. Way to go, Mr. Stephen X. Number two, who's going to take it? Number two, okay. I don't know who I asked, but how about let's get Maria? Would you like to take that one? If not Maria, how about McKenna? Number two. Remember, you have to unmute your phone or your computer.
I can just take it quick.
Thank you.
So it says a customer purchases sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives payment from the customer on February 2nd. So the customer purchases it on January 27th, so that's when the revenue would be recognized.
Super. Excellent. Number three. Who's taking number three? I think it was June.
Yes. Can you hear me?
I can hear you.
Yeah. On March 30, a customer pre-orders 10 supreme pizzas without onion from Pizza Hut for a birthday party. The pizzas are prepared and delivered on April 2. The company received cash at the time of delivery. I think April 2 is the time to be recorded. April 2nd.
Correct, because that's when the service was provided or the product was provided. Number four. Richard.
A customer pays in advance for 3 months of subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st through September 30th. I put that he would pay monthly like July 31st, August 31st, and September 30th.
Excellent. You're exactly right. Other examples of this? Tickets to Vikings games. Even though they pay $4,000 up front, the revenues happen if there's 6 games, when 6 happens as they play. Perfect. Okay, guys, so y'all did those perfect. Now, we're going to talk about measuring. There are adjusting entries that we must make to get our books accurate. And there are certain types of what we call adjusting entries that will need to happen before the end of a period. Now, these adjusting entries are unique in that we have to look internally at our books and decide what needs to be adjusted. So these aren't like external transactions that get recorded. This is some adjusting entries to see of things that have transpired. For example, we may have a prepaid expense on our books, like prepaid rent, prepaid insurance, that we recorded, such as the rent for $6,000. And at the end of the period, we need to look and say, how much of this has been used up? So we can create a journal entry and show what's actually expired, or what rent expense has been incurred, and what is still sitting as an asset. Or we will have had some deferred revenues that have happened where someone gave us cash up front and we were going to provide the services at a later time. When we need to look at that liability account and see, did we provide those services? Is this still a liability, or can we transfer it to a revenue? Or we may have some accrued revenues and accrued expenses. So let's look at these 4 scenarios and look at how we need to record these adjusting journal entries prior to preparing our financial statements. So during the period, we record all these external transactions. Then at the very end of the year, we need to record and post what we're going to now learn about. That's called adjusting entries. From there, we'll prepare financial statements, and then we'll eventually close the books. Now, this week, we're only going to talk about the adjusting entries and what we call an adjusted trial balance. Next week, we're going to talk about preparing financial statements and recording the closing entries. So we're only doing half of this chapter. So some transactions have occurred during the period that have not been recorded by the end of the period. So some of these may be things such as using supplies up, earning interest, rent expiring. These are things that occur daily. So we talk about 2 types of what we call a prepayment or a deferral. Prepaid expenses are where we pay cash to purchase an asset in the current period that's going to be recorded as an expense in a future period. I'm so sorry, guys. Also, deferred revenue is where we received cash in the current period that's going to be recorded as a revenue in a future period. Those are our prepayments and deferrals. Now, our accruals are where we record an expense in the current period that will be paid in cash in a future period, such as a utility bill, where we record the utility expense, but we might credit in accounts payable. Or an accrued revenue means we record a revenue in a current period that will be collected in cash in a future period. So we've got these various transactions. We will show, sorry, so these are the various transactions we've talked about ad nauseum. The prepaid expenses for the cost of assets acquired in one period will be recorded as an expense in a future period. So these costs are initially getting to be recorded as an asset since they provide a future benefit. Look, prepaid rent, prepaid insurance, and there's also assets we depreciate that we'll talk about. But we expense these costs in the future period as the assets get used up. The adjusting entry for all prepaid expenses will be to debit an expense account, and we will credit an asset account. Hang in there with me. Cash paid for rent in advance. We debited the asset prepaid rent, but by the end of the year, some prepaid rent expires. We paid the $6,000 December 1st, but between December 1st and December 31st, we used up $500. $5,500 is all that really remains in our prepaid rent account at the end of the year. So this is an example of a journal entry, an adjusting journal entry we will need to prepare that shows our rent expense, and we reduce our asset. We credit our prepaid rent by $500 because it's no longer an asset. We've used up 1/12 of that rent. Another example, cash was paid for supplies. So on December 6th, we purchased $2,300 of supplies on account. But during the month, we used up $1,000 of those supplies. So really our asset supplies should only have $1,300 in it. We need to prepare an adjusting journal entry that shows a debit to supplies expense and a credit to supplies. Since we used up, they call it consumed, we devoured supplies during the current period. Now here is a new one we're going to talk about. When we purchase equipment, we record that asset equipment when we purchase it. But the truth is, this equipment gets used up over time. And we often determine up front, and we have guidelines, how long this equipment is going to last a company. And we show the use of this equipment or the wear and tear on this equipment by adjusting it to a new account you're going to learn of called depreciation expense. And we credit something we call a contra account called accumulated depreciation, which allows us to show using up this asset over a period of time. So in this example, this asset cost us $24,000, and they determined how much, or $4,800 they're assuming, will get used up each month for the use of this asset. The expense for showing the use of an asset is depreciation expense. And the new word here, accumulated depreciation, is what we call contra account against our equipment account that allows us to keep a tally of how much depreciation we've taken under this specific equipment. Here's an exercise. We're going to go through this. I hope that these exercises really help cement these concepts. So Golden Eagle Company prepares monthly financial statements for its bank. The November and December 31st adjusted trial balances include the following account information. So you see on November 30th, we had a debit to supplies of $2,000. We had a debit to prepaid insurance of $8,000. We had a credit to salaries payable of $11,000 and a credit to deferred revenue of $3,000. Now we're just taking specific accounts that we're going to need to adjust. We see in December, a month later, we show the debit to supplies is $3,500. A debit to prepaid insurance is $6,000. A credit to salaries payable is $16,000. And a credit to deferred revenue is $1,500. Now it's giving us some more information. The following information also is known. We purchased supplies in December totaling $4,500. Okay? B, no insurance payments are made in December. C, $11,000 is paid to employees during December for November salaries. D, November 1st, a tenant pays Golden Eagle $4,500 in advance rent for the period November through January. Deferred revenue is credited. Now, what they're doing is they're giving us the beginning and ending balance for the month of December. They're giving us some information so it helps us to see what else went on in these accounts. And it wants us to show the adjusting entries that were made for supplies, for prepaid insurance, for salaries payable and deferred revenue on December 31st. So what we're doing here is we're looking at someone's books who have been done right, and we are supposed to determine what adjusting journal entries were made for the company. Let's take the first one. When we purchased supplies in December totaling $4,500, think about it. Supplies were at $2,000, okay? Then in December, they purchased $4,500 of supplies. So this account was up to $6,500 at one time, wasn't it? But if the ending balance shows $3,500, it means they had to have created a journal entry debiting supplies expense of $3,000 and crediting supplies of $3,000. Okay, I'm going to just show you how I'm determining this. So if we go into Excel and we show here's our little journal entry, and we are going to just show the account is supplies, okay? We started it with 2,000, I believe. Let's just make sure. We started it with 2,000. We purchased $4,500 in supplies, if I remember correctly. Purchased supplies in December of $4,500. Okay. And our ending balance here shows 3,000, doesn't it? Let's just make sure. No, 3,500 was our ending balance. what is it that has to happen to get this $3,500? Well, don't you see the 2,000 plus the 4,500, 6,500? We had to have had a $3,000 credit to this account, which would have probably been, we used up supplies. Supplies expense of 3,000, we would credit our supplies of 3,000 to end up with a debit in our supplies account of 3,500. Does that make sense, guys? Next, prepaid insurance began at 8,000 and our ending balance was sitting at 6. And it tells us no insurance payments are made in December. Well, if insurance was at 8, and it ends at 6, what had to happen here, guys? We have an insurance expense of 2,000 and we credit, sorry, prepaid insurance. Ah. Didn't we need to credit 2,000 to get us at $6,000 here? Right? Okay. Then the next one shows us salaries payable started at 11,000. It ended at 16,000. And it said 11,000 is paid to employees during December for November's salaries. You see, we started this credit at 11,000, right? So think about it. Just going to create. This is salaries payable. It started at 11,000. It told us, oh, sorry, 11 credit. And it ended with 16. Now, it told us that during the month of December, we paid $11,000 in salaries for salaries that happened in November. So you see what happened is at the end of November, we had a credit sitting here of 11,000. So we must have paid those salaries, which means we would have debited that salaries payable of 11,000. But what adjusting entry had to happen that we have 16,000 sitting in salaries payable at the end of December? Well, wouldn't it have been that we had in December a salaries expense of 16 and we showed a salaries payable of 16 that probably won't get paid until January? You see how we came up with that 16,000 here? Next. Deferred revenue. began at 3,000, ended at 1,500. So that's the first thing I'm going to do. It began at 3,000. Began at 3,000, ended at 1,500. So it says, began at 3,000, ended at 1,500. The following information is also known. On November 1st, a tenant paid Golden Eagle $4,500 in advance rent for the period November through January. Deferred revenue is credited. So that means back on November 1st, Golden Eagle debited cash of $4,500, credited deferred revenue of $4,500 for 3 months of rent. At the end of November, they must have shown that as a rent revenue. So they debited deferred rent for $1,500, credited rent revenue for $1,500, because out of that $4,500, a third of it was turned into revenue. It's no longer a liability. Well, isn't that the same thing that's happening now in December? Another third of that amount that was given to them on November 1st is now revenue. So in this example, it looks to me like we would have debited deferred revenue for $1,500, and we would have credited rent revenue for $1,500 to end up with a credit here of $1,500. Which of the following is recorded with an adjusting entry associated with a prepaid expense? Do we debit, or number one, credit an asset? B, debit a liability? C, credit an expense? Or D, debit an asset? Think about it. With a prepaid expense, let's go back here. Which one of these is a prepaid expense? Supplies and insurance. What are we doing here? For an adjusting entry, aren't we crediting an asset? We debited an expense and we credited the asset to reduce that asset. Does that make sense? So adjusting journal entries involving prepaid expenses, which is an asset, means we would end up crediting that asset. Any questions before I move on? Because we're doing a lot here. Any questions? No? Let's go over some homework real quick. let's look at some questions similar to what we're going through. Now, guys, we just had this problem, so you already have handled that one. We already did that one. Wait, it looks like I might have doubled up on that one. Let me see. Oh, no. Okay. During the course of your examination of the financial statements of Trojan Corporation for the year ended December 31st, 2021, you came across several items needing further consideration. Currently, net income is at $100,000. An insurance policy covering 12 months was purchased on October 1st, 2021 for $24,000. The entire amount was debited to prepaid insurance and no adjusting entry was made for this item in 2021. So if right now this net income's at 100,000, we're going to prepare these adjusting journal entries to see really what our net income should really be. So if this 12-month insurance policy was purchased October 1st for 12 months, which is basically $2,000 a month. So we had debited prepaid insurance, credited cash, okay? From that, sorry guys, we need to look at this prepaid insurance and decide, hey guys, what's our adjusting journal entry need to be at the end of December to adjust our prepaid insurance to what it should be and to adjust our insurance expense.
Hey Nancy,
Yes?
we're still stuck on the PowerPoint screen.
Oh, you're not on here?
No, we don't see what you're talking about right now.
Weird. You're on that?
And it still just shows the PowerPoint.
Okay. Let me go back. Sorry, guys. Can you see it now?
Yeah, now we can.
Guys, I'm so sorry. Okay, so let me just start this again since you couldn't even see what I was talking about. This homework is kind of going over what we just talked about with adjusting entries. It's telling us during the course of your looking at the financial statements of Trojan Corporation for the year ended December 31st, 2021, you come across several items needing further consideration. Currently, net income is at 100,000. So the first thing I did was I put net income in here at 100,000. It says an insurance policy covering 12 months was purchased on October 1st, 2021 for $24,000. The entire amount was debited to prepaid insurance and no adjusting entry was made for this item in 2021. So guys, If we purchased a 12-month insurance policy October 1st for $24,000, that means insurance is really $2,000 a month, isn't it? What adjusting journal entry should we do at December 31st of 2021 to record what's happened already?
Negative 6,000.
Yes, negative 6,000. So what we should do, guys, if you think about it, wouldn't we debit insurance expense of 6,000? And wouldn't we credit prepaid insurance for 6,000? Because we've utilized or used up $6,000. Doesn't that make sense to you? Can you see my screen now?
Yeah.
Okay, can you see when I put on this Excel? Can you see that?
No.
Huh. Okay, thank you. Now, number 2, adjustment for deferred revenue. During 2021, the company received a $4,000 cash advance from a customer for services to be performed in 2022. The $4,000 was incorrectly credited to service revenue. So guys, this is really not an adjusting entry per se. It's more fixing what was screwed up. Okay? Since the work wasn't going to be done until 2022, but they're telling us they screwed up. That $4,000 was credited to service revenue. What should it have been credited to?
Deferred revenue.
Deferred revenue. So what should we do here? We should show a debit to service revenue and a credit to deferred revenue, because that was treated originally as revenue, and it should not have been. There were no supplies listed in the balance sheet under assets. However, you discover that supplies costing $2,750 were on hand at December 31st, 2021. What do you think that means? When they purchased supplies, where do you think they originally recorded it to instead of what they should have done? Could it be when they purchased supplies, they debited supplies expense, credited cash? And they should have debited supplies and credited cash. And they should have switched it to supplies expense when they got used up. But it looks as though the auditors here are going, wow, you have supplies on hand. Wouldn't that mean this $2,750 had been treated as an expense and really should be shown as an asset? Which would basically increase our net income, because this net income up here showed a supplies expense for $2,750 more than it should have. Make sense? Trojan borrowed $70,000 from a local bank on September 1st, 2021. Principal and interest at 9% will be paid on August 31st. No accrual was made for interest in 2021. Let's think about this. When you borrow money, it's not for free. A bank charges you interest to use their money. Don't they? So, trying to I want to share my screen now. Here. Can you guys see my Excel? Can you see this screen, this Excel
Yeah.
here?
I can
Yeah.
see it.
Okay, so if we borrow 70,000 at a 9% interest rate, and this was borrowed on August, let me just confirm it. It was borrowed on September 1st at 9%, okay? So we need to show the interest expense for all of September, all of October, all of November, and all of December, right? Does that make sense? Since we borrowed 70,000 from the bank on September 1st, and it's at a 9% rate. Now, we don't owe this money back to them until next August of 2022. But what has happened during this time in September, October, November, and December? We have incurred interest expense. How do we determine the interest that was incurred? Well, we're going to take our 70,000 times our 9% would mean that interest for an entire 12 months would be $6,300. Okay? But we are only recording 4 months of interest, right? We only need 4 months. This, okay, let me show it this way. This is 12 months of interest. But we need to show September through December what our interest expense is. So 4 months of interest would mean the 6,300, divide that by 3, or 2,100 for 4 months of interest. So if we went back here, new share, I think that's what I have to do. I have to do a new share when I come back. Can you see that now?
Yes, ma'am.
Now we should have 2,100 of interest we need to show as an adjusting journal entry to show that this loan, even though we don't owe it for another year, how much interest have we accrued that we haven't paid? Does that make sense? Now my answer is not complete yet because I need to come up with my net income. So we started with 100,000. Here are these different adjustments, part of our adjusted journal entries. 90,650. I don't know why I can't get that to, oh, I got to return. So what this problem is allowing us to do is to see throughout the year or throughout the period, we record these external transactions. But in order to provide completed financial statements, we need to prepare some adjusting journal entries that are going to take place within the company, such as discovering items related to our prepaids, what's been used up, items related to our deferred revenues, what's actually been earned, and items related to accruals. We owe this bank. We don't owe it until the next year, but we have incurred an expense this year that won't get paid until next year. Okay. Now, we did this problem in our homework or in our PowerPoint. So I just wanted to go back and show you a couple things you didn't get to see earlier. This first problem for homework, we went over. Remember the American Airlines collects cash on June 12th for sale and the customer purchases from Eddie Bauer. We already went over that one. This one, determine the date for which the company recognizes the expense. Remember, we record an expense to match the revenues they help to create. Then this one says, determine the date for which the company recognized revenues using the cash basis of accounting. And these are expenses using the cash basis of accounting. We went over this problem. You're going to have to list these accounting steps in proper order. We went over this problem already on our PowerPoint. Now, I'd like to look at this problem for you guys, okay? Actually, we will do this one in a little bit. Let's go back to the PowerPoint. Now I need to do a new share. That's what I was doing wrong. I'm sorry. Can you see now the PowerPoint, guys?
Yes.
Thank you, Cody. So let's talk a little more in depth about depreciation. I just started right away with a question. Which of the following is equivalent to the book value of an asset? Well, it will be cost of the asset less the accumulated depreciation. So we're going to talk about this contra account accumulated depreciation and how it is used or why it's used. When we create depreciation or recording depreciation, we show the assets at its cost. As you see here, the aircraft, 15 million or billion 632, package and handling support equipment, computers, vehicles. We show the total cost at what we purchased them for. The depreciation we've taken on these assets get lumped into an account called accumulated depreciation. We call this a contra account because we want to keep the asset intact. We want to know exactly what we purchased these assets for. And this allows us to see what we have shown in depreciation against these assets. So our true net asset, what we show on our books for these assets, because we have depreciated a portion of them, is the 19,550,000,000. Now, we know deferred revenues happen when companies receive cash in advance from customers before we've done the work. Cash is received initially and it gets recorded as a liability. But once that obligation or that sacrifice is met, we then can create a revenue. So when we do this, when we initially get the cash, we show it as a liability. But once we have done the service, we can adjust our books to show that we debit that liability account and we get to then credit the revenue account. So if you think about it, we reduce our liability and we increase our revenue, or we debit our liability, we credit our revenue. So when cash is received in advance from a customer for products or services to be provided in the future and recorded as a deferred revenue. But by the end of the year, some of the services are provided. So do you see here, if $200 of those services are provided, do you see how we will debit our deferred revenue and we will credit our service revenue? So we debit our deferred revenue for 200 and we credit our service revenue for 200. Now, there are other liabilities we may need to adjust. And this account, or these problems right here, let's just go over them because they're helpful. Well, actually, I just did this Shaka-Boro. Let's just go over this. So let's look at A, B, C, and D here and take some time to understand what we're going to do to adjust these entries. So I'm going to call on Clay, you just came in. I'm going to call on you to help us with one. If you're able to, you can always pass. Mason B, if you can help us. I'm going to just put some names out here. Noah Zoller. Summer. Oscar. Landry. Gabe. Harmony. Let's have you guys, let's take these 4, and if someone can start with A, and if you get stuck, that's my job. I'll help you. I'll step in. But what I want to do is use this as a learning opportunity so we can process together how we're going to create these adjusting journal entries. So who wants to take A?
I can do A.
Okay. Thank you, Harmony. If you can read it.
On November 28th, 2018, Shocker receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited.
Awesome. So we need to record any adjusting entries as of December 31st. So in a nutshell, can you tell me what's happening here? And why do we need to create an adjusting entry?
So to me, like I see that that it says that the deferred revenue is being credited.
Yes. So does that mean they gave us $4,500 in cash and we're supposed to provide probably $1,500 of services every month, right? For 3 months, $1,500, $1,500, and $1,500. Does that
Right.
make sense?
Yeah.
So chances are in December, we provided that $1,500 of services. So we need to adjust our books accordingly to show we provided those $1,500 of services. So wouldn't we debit our deferred revenue because it's no longer a liability, the $1,500, it's now a revenue, we earned it. So we debit our deferred revenue of $1,500 and we credit our service revenue of $1,500. Doesn't that make sense?
Yeah.
Anybody have questions on this one? Okay, who wants to take thank you so much, Harmony. Who wants to take B?
I can take it.
Thanks, Gabe.
On December 1st, 2018, the company pays the local radio station $2,700 for 30 radio ads that were aired 10 per month throughout December, January, and February. Prepaid advertising is debited. So saying we are paying our radio station $2,700, and that's in December of 2018. And looks like, I'm assuming the December, January, and February would be going into 2019, so the next year. So we would be, let's see, crediting cash and debiting, well, it says we're debiting prepaid advertisement, but after, okay, well, now I'm confused.
It's okay. Gabe, this is part of the journey. It's all right. So basically, on December 1st, we paid $2,700 of prepaid advertising. And that $2,700 was going to be used over 3 months. December, January, and February. Now it's the end of December. A third of that advertising's incurred. It's been used up. It's no longer a prepaid, it's an advertising expense. So 10 of the radio ads out of the 30 we paid for happened. So we're going to take a third of that prepaid advertising, and now it's advertising expense. It's no longer a prepaid asset. You see what I'm saying? It's been used up. Therefore, we debit our advertising expense and we credit our prepaid advertising. Does that make sense, guys?
Mm-hmm.
Who wants to take C?
I'll take it.
Okay.
Employee salaries for the month of December totaling $8,000 will be paid on January 7, 2019. I believe there will be an $8,000 debit to salary expenses and then an $8,000 credit to salaries payable.
Awesome. That's exactly right. Salaries expense, 8,000. Salaries payable, 8,000. How about if you don't mind taking D?
Okay. On August 31st, 2018, Shocker borrows $70,000 from a local bank. A notice signed with principal and 9% interest to be paid on August 31st, 2019.
Mm-hmm.
So that's 12 months, I do believe.
Yeah.
It would be 2 seconds here. There would be a, wait, why is it 2,100 and not 60? Wait, no, never
300.
mind.
6,300 would be for 12 months. But remember, we just have to do September, October, November, and December, right?
Right.
So do you see the 6,300, 70,000 times 9% is for 12 months. But we are wanting our books to be right for December 31st. So we took this loan out August 31st. We don't pay it back until the next year, but we have incurred 4 months of interest. That's why we need to create an adjusting journal entry that shows interest expense of $2,100, and we credit our interest payable of $2,100. Because we're not paying it yet, we're not going to pay it till next August. Does that make sense?
Yeah.
Thank you. So guys, accrued expenses get recorded when a company has a cost that's used to help produce revenue, but hasn't yet paid cash for that cost. Cost is recorded as an expense and the amount owed is recorded as a liability, just like we did here. We debited interest expense, we credited interest payable. Salaries is an example of this. By the end of the year, $300 in salaries have been earned by employees, but not yet paid. So do you see here on December 28th through December 31st, salaries earned by employees were $300. They're not going to get paid until the next period. So we have to show on December 31st a salaries expense of $300 and a salaries payable of $300. Now we know when they get paid on January 4th, then we've satisfied it. But since it goes into another period, we need to appropriately show that expense was incurred in this current period, December, even though it's not going to get paid until January. If a company pays an employee $100 per day for a 5-day work week that runs Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming that Friday's the payday? What do you think it's going to be, guys? Wouldn't we show on December 31st a debit to salaries expense for 200, and we show a credit to salaries payable for 200, because that's the period. It's not by week, it's by month or year. And since December 31st ends on a Tuesday, we need to create an adjusting journal entry to show the salary expense that was incurred in December, even though it won't get paid until January. More utilities. Utility costs of $900 have been incurred but not yet paid. So we need to show that utilities expense of $900 and a utilities payable of $900. By the end of the year, 1 month of interest has been charged for borrowing $10,000 at a 12% interest rate, even though it won't be paid for a year later. We need to show the interest expense, and we credit that interest payable. When recording the interest payable on a borrowed amount, students sometimes mistakenly credit the liability associated with the principal amount, such as they want to take that interest and credit it to notes payable. But we don't do it that way. We record interest payable in a separate account called interest payable, because in that way we keep the balance owed for the principal separate from the balance owed for the interest. Guys, I want you to take a minute, each one of you, and look at this and attempt to do it and put your answer in chat. Tell me when you're ready. So if a company borrowed $20,000 on November 1st at the rate of 6% annually, how much interest expense should be accrued at the year-end date of December 1st, assuming no accrual has yet been made this year? How many months, first of all, are we accruing for? 2 months, November and December. So when we say 20,000 times 6%, that's giving us it for 12 months. But we want to say 20,000 times 6% times 2/12 or 1/6. So that amount would be $200. 20,000 times 6% times 2 months out of 12 months, we would show a debit to interest expense and a credit to your interest payable. Now, last one, accrued revenues are when companies provide products or services to customers but haven't yet received cash. It records the revenue and an asset for the amount expected to be received. We would debit an accounts receivable, and we would credit our service revenue. So we've provided the services, we haven't received the cash yet. That's why we need to show we have an accounts receivable, we're expecting to receive cash, but we get to credit our revenue because we provided the service. So guys, an adjusting entry would be needed for which of the following transactions? Accrued salaries, services provided but unbilled, interest accrued on a loan payable, or all of the above? All of those would need adjusting entries. Adjusting entries are unnecessary for two types of transactions. Transactions that do not involve the recognition of revenues or expenses, or transactions in which we receive cash at the same time we record revenues or pay cash at the same time we record an expense. Because those external transactions take it all into account. We do not need to adjust anything. After we have created all of the adjusting journal entries, then we prepare what we call an adjusted trial balance. This is just like the original trial balance, but this one lists all the account balances after we've updated all those adjusted journal entries. This is gets prepared after we post all of the adjusting journal entries. That's where we end this week. The financial statements will handle next week. But we had to cover a whole lot, guys, because there's so much in this chapter. Can you see I'm back on my homework assignment? Can you see that?
Yeah.
Because guys, sorry I screwed that up earlier. I'm learning about Zoom all the time. Every time I shift from one thing to another, I need to I need to do a new share. So let's look at this problem. Equipment costing $42,000 is purchased at the beginning of the year for cash. Depreciation on the equipment is $7,000 per year. For each of these items, record the necessary adjusting entry for Husky's insurance at December 31st. And if there is not a required adjusting entry, you just say no journal entry required. So in this example, this is an adjusting journal entry. An asset we show needs to be adjusted for the expense that has now incurred. This happens oftentimes when we deal with depreciation or have to remove or adjust for prepaids. In this case, our expense is called what, guys?
Depreciation expense.
Excellent. Of $7,000. And remember that crazy contra account called accumulated depreciation we use in this case for 7,000. Number 2, on June 30th, the company lends its financial officer 50,000. Principal and interest, 7% are due in 1 year. But we need to record the adjusting entry for interest at the end of each year end. Guys, be aware. This isn't money we are borrowing. This is money we are lending to someone. So in this case, just so you know, this is going to be an interest receivable. We're going to receive this interest, and it is interest revenue. Now, how much will we show here, guys?
We should show 21,000, right?
50,000 times 7% times 1/2 of that, half the year. Would it be 1,750? You see why? We lent them $50,000 at a 7% interest rate. We lent it 6 months ago. We're not going to get the money back for another 6 months. But we need to show how much interest has been accrued, and we're going to show it as interest revenue. Due to the passing of time, we've earned this money. We just haven't received it yet. So 50,000 times 7% or 3,500 would be the amount we receive after a year. But how much interest revenue have we earned? Half of it. So we would debit our interest receivable and we would credit our interest revenue. Then, as you see here, this is dealing with a deferred revenue account. And at the end, in October, we received money for insurance. We're an insurance company here. We need to adjust for 3 months of insurance revenue. Next, I just want to show you this one, considering these transactions, indicate how much net income in the income statement is higher and lower if these adjustments did not get recorded. This is showing the importance of recording these adjusting journal entries. Now, again, you're seeing similar questions, just providing the journal entries. This one is showing how does this affect our assets, our liabilities, and our stockholders' equity. Again, journal entries. You know, guys, this is the best way to learn, is by doing the problems and mastering the concepts. So if you have questions on the homework, I hope you guys can work together. As I've told you, you can work together on these problems, your homework. You can work together on the homework and work together in the discussion section for chapter 3. So I hope this has helped you. I'm now going to stop my recording so I can